Estate Radio, hosted by the real estate therapist Larry Shakman, a top producing real estate broker, author, CEO, and founder of TrustedAgentUSA.com, the ultimate real estate matchmaker, connecting you with top performing agents for 2% commission. Each week, we bring you exclusive interviews with industry experts, covering everything from staging to negotiation strategies to home inspection issues and everything in between. Whether you're selling your home, a first-time home buyer, or a seasoned investor, we've got you covered. Let's make your real estate dreams a reality in this fast-moving and ever-changing real estate market. This program is funded in whole or in part by Trusted Agent USA, Illinois license number 475-145-795. Now, here's Larry.
All right, welcome everybody, and we are glad to have you joining us. You are currently tuned in to the Real Estate Radio Show podcast, because you can find us wherever you listen to your favorite podcasts. Now, we're of course going to be streaming live on Facebook, YouTube, and LinkedIn. So because we are broadcasting remotely today, we won't be taking any calls, but you can text us, certainly if you're watching us at any of those platforms. We have a great show today. My name's Larry Shakman. I'm going to be your host for the next hour, and we're going to be jumping around and talking about a lot of different topics. We have two great guests on, which I'll mention in a minute. And actually, let's mention them right now. John Hoffman's going to be on from Why Rent Real Estate, and Dylan Kramer is going to be joining us as well from Neighborhood Loans. And like I said, we have a lot to talk about, a little bit of house cleaning. Like I said, because we are broadcasting remotely today, we won't be taking any calls. However, you can reach us every other Saturday at 773-9278. That's 773-763-9278 every Saturday, 9 a.m., broadcasting live from the studios of WCPT 820 a.m. And like I said, we have a lot to talk about today. I want to cover a couple of things real quickly, then we'll bring our guests on. So on June 22nd, if you're a real estate agent, you do not want to miss this show. It's going to be a real game changer. We have joining us, Joe Peterson, who is the CEO at iList Tech. And iList Tech offers agents a whole new way to offer just amazing things to their sellers. Many different ways to sell their homes, from whether you want to participate in an auction, cash deal, many different things. So that's going to be an exciting show. And that is the 22nd. Joe Peterson, CEO of iList Tech. Like I mentioned, the last couple of weeks, I don't mean to keep teasing people, but in the next week or so, we are going to be announcing a great brokerage that's coming into the Chicago market for the first time. And I really think this brokerage is going to catch the eye of consumers and agents alike. Consumers are going to be able to take advantage of a wide array of marketing to get their homes out there front and center, particularly, obviously, sellers. And agents are also going to have a lot more opportunities to get that home in front of the public so they could sell it faster for more money. And we'll get into that a little bit too. So the market is active still, lots of buyers out there, and but not a lot of inventory, even though it is creeping up a little bit. The inventory is still low. So here's some quick headlines real quick. The Fed at their last meeting, which we'll talk to Dylan and John about, they held interest rates firm, the Fed rate firm, as a result of the market, the economy still being pretty hot. So they're not going to lower interest rates while the economy is hot. And one indication of that is we added 272,000 jobs in May, which was way above and beyond what anyone expected. John may have an opinion on that. I think I saw him do a little video on that. And so that's one of the reasons the Fed rate held firm. Also, interest rates, and Dylan will correct me if I'm wrong on this, but they're kind of sticking right around 7% where they've been, little higher, little lower over the last several months. So we'll get into that as well. We are going to bring Dylan and John on in a second after this quick break.
Welcome back to Real Estate Radio, sponsored in part by TrustedAgentUSA.com, the ultimate real estate matchmaker, saving you thousands. Now back to Larry, the real estate therapist.
All right, everybody, welcome back. And we are joined by two real estate savants. That is John Hoffman of Why Rent Real Estate and Dylan Kramer of Neighborhood Loans. And like I said, we got a lot to talk about, guys. There's some things going on that indicate what's happening in the economy. I'm sure you both have opinions on that. So let's
John,
really
how are you?
just get into it. Yeah, I'm doing good. How are you guys doing, by the way?
Good. Larry, how you been?
Good. Doing great.
Awesome.
Great. So let's start out with this Fed meeting that recently took place. That was a couple days ago. And I really want to dive in to the Fed rate, because I think a lot of people get confused about the Fed rate, what consumers pay, their interest rate. And I think people can sometimes get confused on that. So I want to clear that up to you, and specifically what the Fed rate affects more than not, because a lot of people think, right, Dylan, it affects mortgage rates.
Yes.
Where really it doesn't. It can, but it typically does not. Correct?
It can. So keep in mind, I want to remind everybody, look, we're in a situation with the Fed that they're in charge of the shortest interest rate in the economy. It's the overnight bank lending rate. So if Bank of America needs to borrow, they cash too many checks or whatever from Citibank, they lend them the money overnight at whatever that rate is. Now, that rate is literally the shortest overnight lending rate, right? It's in the name.
Mm-hmm.
The 30-year fixed rate mortgage is the longest rate in the economy, and there's no situation that the Fed's pushing the lever of the overnight rate directly impacts mortgages. Mortgage rates are set by the mortgage-backed securities market. My mortgage, your mortgage, the next guy's mortgage, the mortgages the economy creates over the next 6 months all get bundled and sold into mortgage-backed securities, which are bought and sold in the financial markets. Those trade every day, and that's what rates are set on. And so the Fed is, interesting to me, because I've been this Fed meeting made me kind of change my opinion. And what I mean by that is, for a while, Larry, you heard me say, I think they're a little behind the curve, or maybe they're a little stupid, or maybe they're a little too smart for their own good.
Maybe all that.
Yeah, I've come to believe that they actually are trapped. Like, they have no good answers, and there's no good out.
I think we're all in agreement on that.
We're in a situation. I mean, and part of this is they're a little bit more of a political animal than they used to be 20 plus years ago. I mean, I remember during the Clinton administration, he was trying to pass a big spending agenda, and bonds revolted as soon as it got and rates went up as soon as it got proposed to Congress. And he was like, I can't believe a bunch of, MF, insert your cursing here, bond traders are preventing me from doing this. And the term bond vigilantes was born. And the bond market had historically kept kind of the Fed and the political system in check. And I think that still kind of exists here today. So we have just enough growth, but not so much growth that people feel good about their economic situation. We have just enough inflation that they can't really lower rates. We have just enough employment that they can't really lower rates. But nobody seems to be, except at the very, very top of the economy, right? People who are really, really wealthy and really have stock holdings, your Elon Musk's and Jeff Bezos's of the world. Everybody else feels like it's like they got a cold they can't shake economically.
Yeah,
and
for sure.
And so they can't really move rates up or down, because it gets a lot worse for people if rates go up it
Yeah.
gets really ugly from a financial market standpoint. Because remember, the Fed is perceived to be in charge of inflation and inflation expectations, and that's what mortgage rates react to. And so
Yeah.
if the Fed cuts rates when the market math isn't there, again, according to the bond vigilantes, you could see the Fed cut rates and you could see mortgage rates jump, which would be, people would be like,
Yeah,
how does
you're
that
right.
happen? And that's because if they feel like the Fed is behind the curve financially, then the financial markets are like, well, we'll just take care of it. It's no problem.
Yeah.
And
They-
at that point, you'd move from 7.25 to 8 like that.
Yeah.
They really should have started raising rates sooner. And I still think they should have gone a couple ticks higher. You know, they're afraid of the pain. And it's like you said, Dylan, they're trapped. They don't,
Yeah.
if they start lowering rates, the inflation's going to get out of control again. So they're kind of sitting here at this point that they don't even know what that is for themselves. They really don't know what to do at this point. So they're doing nothing. You know, it's like, that's what my, father used to tell me, when in doubt, do nothing. Well, that's what they're doing.
Right.
You know,
they're sitting
Dylan,
there.
I think you hit it right on the head. And that is, they're trying to maneuver through this very precarious time where inflation went down 0.1%, not enough, but it went down to 3.3%. But we're still higher than we want to be. And they're trying to just figure this out without making that one wrong move that could really set people back if they don't think it through.
Yeah, well, the other thing that's kind of the unspoken dirty little secret that nobody will want to talk about in the election is, look, interest payments are exploding as a percentage of the national budget, the federal government's budget. And that's because when rates were low, the opportunity to take long-term locked-in financing was not available to the Janet Yellen Treasury. A lot of people are like mad at her, like, oh, we should have locked all that debt up for 30 years. Nobody at the financial market level, there's nobody at Goldman Sachs who was like, you know, it'd be a good idea to let the government borrow a bunch of money for 30 years at 3%. They're like, no, you could have it for 5%, right? And because they know really smart people are at these companies. And so the thing is that gave the financial markets flexibility, but it really took flexibility away from the government. And we continue to spend at a very high level, not to be, I don't want to make that a Republican or a Democrat or right or a left issue. It's a budget issue. And at the end of the day, without some magic source of additional revenue, they're going to have a real problem servicing the debt. And that's a negative both for the economy, but also for interest rates.
Yeah. Well, credit card interest rates are averaging about 21% right now. So they're killing people.
It wouldn't surprise me to see that go higher. I mean, Larry, one of the things from this trick bag that you and I have talked about on this show before, but I'm going to say, look, there are only 3 things that can happen in the global world of real estate mortgage rates, right? Number 1, rates go higher. Number 2, rates stay the same. Number 3, rates fall. I think in the grand scheme of things, your only options are realistically a best case scenario that rates stay the same, but more likely that rates are going higher. So you may not like 7% mortgage rates if you're a home buyer, but the cool thing is, even if prices are higher, if you buy a $350,000 house today and inflation stays in place, it'll be a $450,000 house before too long, and you should probably do that.
Yeah. Well, let's keep our fingers crossed and hope it goes down.
It's like the general population too. They don't know. They don't care about CPI. They don't care about interest. You know, what's the inflation at? Is it down? Is it up? They just go to the store and they got 3 kids and they can't afford their grocery bills. You know, up 40%. That's all they care about. That's why, like you said, Dill, it's like people are just, people are worried. They're in a precarious situation. Like, what's this doing? But they don't like it. They don't care what these CPI numbers say and all this other BS.
I agree, John. Right, John. They go to the store and they feel their pain based on what their final click is on the receipt that they're paying.
And too, I was going to tell you guys too, it's like the job thing. It's like, if you look under the hood of this stuff, we're losing full-time jobs and we're adding all these part-time jobs because people are getting multiple jobs so they can afford their bills. I mean, and then they downgrade what the jobs were the next month. So it's very misleading. And, you got to go into the Bureau of Labor Statistics just to unpack it all,
all of these stats,
right?
All of these economic statistics tend to butt up against one another. So you get one statistic sounds good, but then you get another stat that kind of butts up against that and undercuts it. So it can be very confusing. So we figured out, we made the explanation, let's say, that the Fed rate is set by the U.S. Central Bank. It doesn't typically affect mortgage rates, but Dylan, what does it affect? Because it affects, like, let's take credit cards, for instance.
Yeah, it directly affects credit cards. If the Fed raises rates today, you can bet $1 that your credit card in your wallet will go up at least exactly what the Fed raises rates. It might go up more, but in essence, look, credit cards, equity lines, lots of things that come pretty much directly from banks are tied to the idea that whatever the Fed funds rate is, which is the Fed controlled rate, we're going to add our spread. And for a home equity loan, the spread might be that much. And for a credit card, it might be that much, right? So 8%, 22%. And so they'll turn around and at least increase it based on the increase in the Fed funds rate. But if they feel like there's additional risk in the economy because rates keep going up, they'll also increase the spread. And that's when things get really expensive.
Well, let me ask you something. So when the Fed lowers their rate, are you typically going to see your credit card rates go down?
You typically do, but with a lag. One of the things that I have said over the years to folks is, look, rates go up with a rocket ship and they come down with a parachute.
Yep.
What about auto loans?
Auto loans are a little more sensitive to rates and can also be sensitive to financing incentives from, companies that want to move metal, right? So there's a lot of, I was reading an article actually in the last couple of days where some, mostly the Stellantis or old Chrysler owned brands, but also some additional Kias and Hyundais and some of that stuff where they're throwing money at financing incentives in order to figure out ways to get people to take the cars off the lots, right? And so, and this is actually a very good lesson in real estate, right? We keep talking about, hey, with clients that they're waiting for real estate prices to come down. And that's not always the answer, because at the end of the day, look, if you save $1,000 on a car, but you still have to borrow at 8.75, it might be whatever the amount is, it might be $800 a month, and getting $1,000 off might make it $765. Well, great. But if you can get 0% financing on the full amount and not $1,000 off, it might be $685 a month, and now it's an affordable car. So the financing can drive the bus in the auto world in a way that is not directly affected. The other thing is the car business is so competitive. And I know one of my best clients, longest time clients, is a general manager of multiple dealerships. And so I talk to him at least once a month about what they're seeing, what we're seeing, where the economy's at, that sort of stuff. And they really react quickly. So if the Fed were to cut rates a quarter point, very quickly they're in the rate cutting business. Like that's because if they don't, if you're look, just drive up North Avenue, literally in Chicagoland, from the lake all the way out to St. Charles, you pass dozens, if not 100 car dealers. They all will take that quarter point and put it right on the street in order to make the next deal with a client.
And I think that's how dealerships do it. They fight interest rates by offering incentives. So, like,
have you noticed too that all the lots are full now? Remember the days of the empty lots?
The only people who have empty lots right now are Honda and Toyota, frankly.
That I believe.
And that's because, look, they're not. That's not a whimsical purchase brand, either one of those, right? Like, at the end of the day, if you're a Honda guy or gal or family or Toyota family, the bottom line is you need a new car every 6-8 years, and they
Yeah.
go in there and it's just your turn at the wheel.
Yeah.
Yeah.
It's a whole nother thing to be like, I want the new Ford Bronco, right? Just to pull a random car out of the air, Larry.
Yeah. Hey, you have a nice one.
I do like that
You
car.
don't
Don't kid
need a
yourself.
new Ford Bronco. You
No,
have
no,
a nice.
I don't. But I would tell you that I'm part of the Ford spiked sales between the new Bronco and the Maverick in the last 3 to 4 years, and that's kind of petered out a little bit. But they rolled those
Mhm.
two cars out, and you had to literally, like I did, sign up. And they're like, "Yeah, we'll get you a car in about a year," which is what it took. I literally signed up in July of 2020 to get the new Bronco. I paid a deposit, and I got the car in November of 21.
Mhm.
And they turned around, had a bunch of pent up demand, made a bunch of money with that, but they don't have that anymore. And so that
Right.
spike in sales is no longer there. And there's a handful of cars that are like that, and they're owned or they're those badges are owned and run by not companies named Honda and Toyota, and I think that for to use your phrase and make it analogous to the car market, that's a bread and butter market, right? Honda, Toyota.
Yeah.
Hey,
Yeah.
did you guys see I believe it was Hertz, the rental cars? They had bought a huge inventory of EVs to use as rental cars, and they finally got to the point where they shut it down, and now they're trying to sell the inventory they have of the EVs because it wasn't worth it to them, and they literally can't sell them. They're putting on no haggle price of 25,000 for these Teslas and that they
Oh,
bought
really?
for used cars. Oh yeah, it's a big deal if you go
The
Google it.
Zillow of the car market.
Yeah, well,
Yeah.
the thing that I think that they forgot, like I get the idea that it seems kind of marketing cool to be like, hey, we got a bunch of Teslas, and there's always an element of, if I was renting a car, I might rent a Tesla, right?
Yeah, right.
But then you end up
It's
driving a
sexy.
Tesla around, and all of a sudden you're freaking out. You're like, where's a charging station? I don't know how this thing
Right.
works. And so
Totally,
if you're
yeah.
not
Yeah.
a regular EV driver, all the brain capacity while you're on vacation or on a business trip,
All right.
you're like, why am I dealing with this? So all of a sudden you rent it once. You're like, even if you're a twice a month car renter in business travel, it didn't
Mhm.
take but one time to rent a Tesla, and you're like, forget that.
Yeah,
I need
right.
that like I need a hole in the head.
Yeah.
Right.
Hey, last thing regarding the Fed rate, and I think I know the answer to this, but I need you to confirm this for me, both of you guys. So regarding, and we all know what recently has happened with student loans, right? So the Fed rate doesn't really affect student loans, does it? Because those are fixed typically.
It's fixed and it's set by statute. Now, I would tell you that there's probably some impact in the calculation for
Mhm.
Fed rates, but that's kind of we go in and this year we're going to lend the money at this rate. And, it's again, rates are here. We're going to add our spread and we go from there.
Yeah.
And then there's different types of student loans, right? The federal guaranteed student loans is different than the one that they'll lend to parents if you have a tuition gap.
Right.
So John, you got kids in college. What are they dealing with? Are they still in college or they graduated?
They're done. They
Oh, they're
luckily
done. Okay.
got out of it pretty much unscathed with, having a ton of debt and all that. But yeah, I don't know the college thing. I mean, I know people that are in their 50s that are still paying student loans.
Well, don't tell Dylan that because he just sent one of his off to University of Iowa.
Did you? Yeah.
Well, you know what? I was blessed this month that I had a bunch of graduations, and by a bunch I mean two, one for each kid, right? One graduated
That's
from
a
high
bunch.
school and one
I
from
know.
college. And I will tell you, it is it's an alarming thing when you pay 4 years of tuition. You're like, whoo, and you're only at the halfway point.
Yeah. Well, a lot of kids are opting out for 2 years of junior college to get their
they should too.
electives in and not pay insane amounts of money to
Right.
get what they could get at College of DuPage or Oakton or other community colleges.
Right.
It is certainly an option for some families. It's apparently not an option for my wife or my kids. So here I am.
Only the best for the Kramer kids.
Yeah, no. You know what? I'm blessed to have really smart kids,
Yeah.
and live in a place with we're a really competitive school district. So yeah, I'm on the hook for a second Big Ten education. You bet.
Yeah.
Sign me
Oh
up.
man, Jesus.
Well,
Big
John,
Ten,
No,
isn't
the
it
younger one
20 now?
the younger one goes to Illinois in the fall. So at least it's a little more
Okay.
affordable than I
Well,
am.
now it's the Big 20, isn't it? Didn't they
Yeah,
add
no joke, right?
at the West Coast? Yeah, it's
They sure
crazy,
did. I
man.
mean, I think there's 18 of them in the Big Ten now.
Yeah,
John's daughter's a professional golfer, so she's
yeah,
gonna
not
kind
yet.
of carry the
She'd like
bag
to-
for John.
Yeah, she'd love to be.
Nice.
She's a great golfer, though.
Oh yeah, she's good. She's good, but she, you got to work the craft, man. If you're not working it all the time, and
Oh,
her
yeah.
job's getting in the way now, so
Yeah.
that's kind of the way that goes, you know.
Dylan's
Right.
a big golfer too, and you know what? If you're not golfing twice a week at least,
Yeah,
it's a
me
crapshoot
too.
anytime
I
you
would
go
tell
out
you,
there.
Larry, it's
Me too.
it's probably 3 times.
Yeah.
Like twice
I
a
don't
week,
doubt that.
you stop getting worse, but you don't really start to improve as a recreational golfer until you're playing at least 3 times a week.
Larry,
Yeah, well,
it's the
I'm into
least we can
pickleball,
do.
so whatever.
It's the least we can do for ourselves.
Yeah.
For being in this business right now.
Yeah,
You know?
no kidding.
Seriously.
Okay, so enough about rates. The Fed rate doesn't necessarily affect mortgage rates, although it can. It affects more short-term rates, and the Fed rate is certainly not what consumers are going to be paying for interest. But
Right.
I just wanted to clear that up for our audience so that they know, these things, they correlate, but they don't correlate all the time. So it just depends on what interest rate you're talking about, long-term or short-term, so on. So John is big in the REO market as well as the retail market. I know you're doing more retail now because the REO market has slowed down. So give us a little perspective on what's going on with the REO market and short sales and distress market in general.
I mean, basically, it's funny. I think I mentioned you the other day. I just did an eviction finally after 2 years. First, I used to do, 1 to 2 a month, and I finally did one, and after 2 years, and I actually have another one in 2 weeks. And these houses, these people are in forbearance forever, and with no intention of paying. And it's actually funny. I just read the other day that now the servicers. It used to be, if you were behind, you could go, hey, I want forbearance, and they'll put you in forbearance. Now, the servicer, even if they can't get a hold of you, will put you in forbearance just to set you aside, so to speak.
Because they don't want to deal with it.
Yeah, it's just, anything that's toxic, just set it aside. That's kind of what they're doing. The house, it's like the house we evicted the other day, the windows were so rotted out that they all had openings in them to the outside.
Yeah.
And these people were living in this house. Okay. But that's how, quote unquote, used up these homes are, because they haven't paid since probably 2020, 2018.
They don't have the money to maintain
They don't have the money. But when you put them in forbearance, that doesn't take care of the maintenance items. The maintenance on these houses is just horrible. And what's happening is a lot of these people who can't pay are just sitting in forbearance. It's like they're on the sidelines. And that's why there's no foreclosures. There's literally nothing out there right now. And VA just announced that, and God bless our vets. They just announced that they're going to come up with a program for the people that are behind. Well, what does that tell you when they're coming out and telling you that there's a lot of people behind,
Yeah.
So everything's kicked the can down the road completely.
Well, and I think one of the reasons they're doing that, and I could be wrong, but I think because of this new rule coming up and the Fed really wants to decouple commissions completely. They want to make it so that buyer's agents are paid by the buyer, listing agents are paid by the seller. Now, if that's the case, part of the problem with VA loans, and Dylan, you'll know more about this than me, is that you cannot, as a VA loan using that product, you cannot pay your broker anything. So,
they just changed that.
You know what, Larry? We got a little guidance on that this week.
Yeah,
but it's also clear as mud, right? So it's one of these things that they've come out and said, hey, the veteran can now pay the buyer's broker, and it has to be customary. It has to be built into the contract. It has to be considered in the appraisal. There's a lot of if, but, but at least it's a step in the right direction for the veteran home buyer. I just don't know. One of the challenges in the VA space is also one of the good things, and that is that the VA is here to encourage and insure loans that lenders have decided to make, but they leave the decision up to the lenders. So this guidance is deliberately vague. They have guidelines, not rules in VA lending, and they leave it up to the discretion of the lender. Generally speaking, they'll insure the loan. It'll probably work out. But I would tell you that over the next little while, as we have a changing landscape due to the NAR settlement and the decisions companies make as to how to approach this differently, we don't know what best practices are going to be. Because of that, this guidance from the VA may not solve it. It may.
Yeah, and I think what you said is really key, and that is it's so murky that it's going to be hard to figure out, and they're going to have to figure that out, because as the rules were, you weren't able to pay a broker. Well, now they're coming out with these murky rules based on what you're saying, and how are we going to maneuver through that? How are agents, how are VA buyers going to maneuver through all that?
Correct.
No, I'm looking for an answer.
Oh, well, I mean, I look, I don't really have an answer. I think that, right, that John's 100% right. I mean, look, the thing is, it's not going to be out till August 10th, which means it's going to be after most of the companies have had to make decisions. And look, just based on what I read yesterday, the question is it usual and customary for the buyer to pay a buyer broker fee anywhere? And the answer is, well, it depends on your definition, because and then if you're lender A, right, pick a company, you're like, hey, it's coming from the sellers. Well, then aren't you confirming the basis of the lawsuit, that it was kind of fixed and it's the seller's money anyway, which we were arguing that it's not. It's so, and
the whole thing is murky.
Right.
And then if the whole thing is murky, the settlement.
What if every deal, what if every deal that happens as a result of this, and this is just hypothetical, but now you get a VA appraiser or an appraiser on a VA transaction, right? And he comes in and he goes, yeah, this is fine. It's all good. And here's your $200,000 deal. And I think it's worth $195,000. I'm like, what about the 2.5%? They're like, no, it's not part of the deal anymore. And now you're $5,000 light on appraisal on a $200,000 loan.
Yeah.
My agents have been asking me, what's happening? I don't know. I'll see you in August. I mean, exactly. until they lay this stuff out,
that's what everyone's saying.
Going on
in August.
Yeah. I think that's a real thing, John, for sure. I think that, look, I think that everybody's trying, this is very much like the TRID rules, right? So I use this example, not to get too, I'll keep it brief. When they rolled out the disclosure to the consumers about closing, there were a bunch of companies that decided, hey, what are we going to do in terms of getting that 3-day ahead of time disclosure out to clients? Some people were like, you got to be clear to close. Some people were like, you got to do this. Some people, all these different rules. And it took about 1.5 years till, in essence, the industry was like, okay, here's what companies who are succeeding in following these rules are doing from a business process standpoint. And now it's fairly straightforward. So like here at Neighborhood Loans, you get assigned somebody, and this is very similar to my previous employer, and it's very similar to other competitors in the market. You're going to get numbers, and we're just going to tell you, look, these numbers are not perfectly accurate, but you need to sign them. And then you can close in 3 business days, right? And that's that. And you have to understand that the sellers haven't confirmed it. And in our market, right, we're an attorney-driven title business more often than not, Larry's business notwithstanding. And so you end up in a situation where lots of these attorneys, they don't want to order title until you're clear to close, because Some of them end up with a putback fee. Some of them just don't want to make extra work. They don't want their staff working on titles for loans that may not close. And so it becomes difficult to get the seller figures in a timely fashion 3 days before closing. And so all of that has made a big mess. And so now companies are like, we're just sending something, which is really, to my point, Larry, that I've been saying for months about the NAR settlement. The point of this, the consumer, ironclad, accurate numbers 3 days before the closing. What we have now is what we had before, except that you legally have to sign 3 days before closing. We have a reasonably good assessment, but not 100% accurate 3 days before closing. Please sign here.
So with my title agency, what we do when a deal falls out and we're already pretty much more than halfway done with title and everything we need to do on that, we just put it on hold because we know we're getting another contract in another 10 to 15 days, which has happened every time.
And that's this market. I think you're going to find that there'll be a little bit different positioning on it when we're not in as strong a real estate market, right?
Yeah. Well, when we have more inventory.
Correct.
And
good luck with that.
Yeah. So John, let's get back into REOs. Where is this market at right now? Where is the REO?
There's nothing. There is no REO. It's just you're either in forbearance or you're making your payments on time. That's it. There's you're not foreclosed. They just set you aside, and there's a log jam of that out there. How much, we don't really know. But, and I mean, the thing you got to keep in mind too is that, people that bought in like 19, 20, they have arms. A lot of them had arms that are going to adjust. Mm-hmm. And now, boom, now we're into a whole new interest rate. Plus the homeowners insurance is doubled, we'll call it. I've sold a couple buyers homes and, young first-time buyers, and the homeowners insurance is like $2,200 a year. I'm like, hey, but what happened to 600 or 800 or 1,000?
I'm moving somebody back from Florida. If you think homeowner insurance is bad here, Florida is insane.
Yeah, Florida, it's a whole other game, right?
Yeah.
But the REO is just, there's nothing there right now. But there is a backup of it. How much, we don't know. But I mean, basically everybody, if you can't pay, you go into forbearance. There's not, even if you don't care to stay there, even if you don't want the home, you could move out. And I've gotten a couple of those where they've been gone for 3 years, because they're not doing anything with those. Only if they're almost forced at gunpoint to take these and make them into an REO that they actually put on a market, they'll do it. But most of the stuff is just being set aside for later. And I know the election's got to have something to do with that. Don't want blood in the streets. So let's just keep all that under wraps,
Yeah. So the short sale market is the same then. I mean, if the REO market is nowhere, there's nothing going on.
Yeah, there's nothing.
Yeah.
Nothing out there.
It's interesting. I remember when I was heavy into REOs. I mean, you mentioned how you used to do 2-3 a month.
Yeah.
And these are the first 2 evictions you've had in
2 years.
A long time.
Yeah.
Back in the day, 2009, 2010, Dylan, I'm not kidding you. I was doing 4 evictions a week.
Yeah, I remember those.
That's not good for your personal safety, buddy.
It's really. Not. I had a large man helping me though, so I was never in any real danger.
You weren't even there.
I wasn't even. No, you're right. I wasn't there. I had 500 properties in my inventory. There was no way for me to be at all those things. But
I remember those days, man. I remember that.
It's a labor-intensive business, right, John?
Absolutely.
I keep telling my partner who's into luxury properties. I said the difference between what you do and what I did in the REO business is the difference between being at a 4th of July parade and being in the fields of the Vietnam War is what I did. And he's prancing through the tulip fields in Michigan, because it's a whole different ballgame. It's a whole different kind of real estate.
Hey, and I got another example for you. I got a property, the one that I'm evicting in a couple weeks, and this bank shall remain nameless. Larry knows who it is. But anyways, it used to be, and Larry knows this, it used to be you'd get the assignment. okay, go over there, check it out. Who's there? How you doing? I'm whatever. And these properties would be, do you want relocation assistance or do you want to just be evicted? You know, they'd be like, okay, well, I'll take relocation or I'll take, whatever. Okay, no, just if they don't take the relocation assistance, then it becomes, you give it to the bank. They go, okay, we'll just evict them. And then in about 2-3 months, you got an eviction date ready to roll. Well, now every 2 months for the last year and a half on this property, they keep telling me to go offer them relocation assistance to the point where the guy's laughing at me going, I've already told you no, I don't want your stupid money. I don't want your money because it won't get me anywhere, But that's how oversensitive and kind they become with these people that, to the point where you're offering them relocation assistance for 2 years. I mean,
what's sad about that, John? They're just not offering enough to make it worth.
No, there's not enough there. $4,000.
Yeah.
I mean, what is that going to get you?
Yeah, nothing. Exactly.
You can't really even get yourself moved for $4,000.
You can't even move for that amount, right?
No, it's difficult to do. But what's also sad about that on the other end is if they don't take the relo assistance, then dude, they're out of luck. They're going to get evicted. Their stuff's going to be put on the curb and they're done with no money. Right. So it's just sad all the way around. They really need to be offering like $12,000-$15,000 to these people in order to get them,
if not more.
Yeah, if not more. But I would say if they upped it to somewhere between 10 and 15 grand, I don't think that guy would have said no.
Yeah.
I think he would have.
I mean, keep in mind too, is a lot of some of these I've got have been 4 years. 5 years.
That's crazy.
And that's at the point that it came into my inventory, which means for 2 years prior to that, he wasn't paying.
Well, and so there's the $4,000 answer, right? Like at the end of the day, even if the rent is cheap at $1,000 a month or the mortgage is cheap at $1,000 a month, now you're making 12 a year and you want to give me $4,000 to leave?
Right.
I've been here for 4 years at $1,000 a month, 4 years at $2,000 a month.
Exactly. Yeah. Give them 15 grand and start moving these properties through the system.
Right.
I mean,
but the ones where it's like the properties, like I said, where they're in forbearance and they're automatically putting them in forbearance now, whether they get a hold of them or not. Who's paying that? I mean, the Fed, that's part of this inflation conversation. It's like all the money they pump into this, when this could be a fresh start for some buyers, get this house on the market and get, hey,
exactly.
Bad things happen.
One of the
things happen to people.
Yeah, one of the things that I think this mechanism exists, right, in the bankruptcy court system and all that stuff, is we have a bunch of rules and systems in place, and we just need to use them and not be scared to use them in terms of dealing with people who come across hard times. The thing that I thought was interesting is there was a study, and in some of the sand states, by the time we were just getting moving on our foreclosure market in what, Larry, 2012, right? I mean, it really took a little longer for it to shake out and get to the point where we're moving properties. There were people in Arizona who had short sailed their place in 2007 at the beginning. And they did their 4 years of not being able to buy another place, went and rebuilt their lives, got divorced, got into a different relationship, changed jobs, changed places of residence. They are owning houses again because they were able to get back on the program. And the albatross of not dealing with this drags the economy. And
Absolutely.
And at the end of the day, look, I think that you'll move the economy along nicely if I like to tell this story. I had a guy in 2012 here, bought a place on North Avenue. There's that street again. It was a very typical city of Chicago condo conversion in the mid 2000s, right? In the mid aughts, right? 05, 06. And so it was 3 condos and a chiropractor office on the ground floor. So four units. He bought the top unit, which the previous owner paid like $265 for $84,000, and did a renovation loan for another $27,000. Redid the kitchen, new cabinets, redid the bathrooms, moved in. Rooftop deck overlooking the park, which may or may not be a good thing depending on what's going on in the park on any given night. But he turned around and sold that place in 2019 for $485,000.
Boom.
And
There you go.
the thing is that if you just sit on his foreclosure for 4 or 5 more years, he never buys it. It never gets back on the tax rolls.
Yeah.
It never gets
Right.
rehabbed.
Right.
Those real estate commissions don't get earned. All that stuff doesn't happen for the economy because we're so worried about what's going to happen to an individual owner. We have to be
Right.
worried about what's happening in the big picture. Like, look, man, I tell people we got tools and systems for everything. Another circumstance, like I tell people who are unmarried, they should not buy real estate together. They're like, what do you mean? I'm like, one of you should buy it. Well, then the other one is going to be their landlord. Yes. Or go get married. And I don't mean that in a religious way. Like, I'm not thumping the Bible like, hey, you shouldn't live together. Like, do whatever you want. But at the end of the day, if you get divorced from somebody and you own property together, you get to go to a divorce lawyer and file a suit and be like, look, on September 6th or October 2nd, we're going to come to court and figure out how we're settling this because I can avail myself of the legal system because I'm a married person.
How do you do that with single people?
Right. If you're just shacked up and one person goes, I'm out of here, and they turn around and take a job 3 states away and disappear, and they stop sending their half of the payment, and you're like, I would like to own this property myself. I would, and that you can't even drag them to court and get them to deal with you.
And Dylan, on your point, I'm sorry, go ahead.
Yeah. So my point, my ultimate point is, use the systems that are in place to deal with these issues as it relates to payments not being made, and let the rest of the system do it. Investors will come in and flip these places. You want to solve the inventory problem? Foreclose on all these properties and sell them to people with renovation loans.
Right. I mean, that's the thing.
Here.
That's why these prices are too high too, because that's more inventory that's not there. And Danny could just foreclose, done, move on, put these back, whatever bank, and get them out there so that we have a little more inventory. Maybe it's not a ton, but at least it's
enough, and it helps because we're going to take a quick break and come back and talk about inventory because there's some things going on with that, and Fannie and Freddie could help that if they would move this process along more, and they would help the people in foreclosure as well. All right, we'll be back in 30 seconds.
Welcome back to Real Estate Radio, sponsored in part by TrustedAgentUSA.com, the ultimate real estate matchmaker, saving you thousands. Now back to Larry, the real estate therapist.
All right, everybody, we are back and we are talking with Dylan Kramer of Neighborhood Loans and John Hoffman of Why Rent Real Estate. And we were just about to get into inventory a little bit. So inventory still, John, steadily rises. Okay, we're getting more listings on the market, not enough, but inching ahead a little bit and getting more listings on the market. Part of the problem is these properties sell so fast that they're off the market. They're on the market, they're off the market. And I don't care what price range we're talking about. Believe me, the luxury market is just as hot as the bread and butter market if you check off all the boxes and do things right. So inventory, although it's inching up a little bit here, we're still 20% behind where it was pre-pandemic levels.
Yeah, the inventory there's nothing to be found. Anything under 300. It's almost, quit looking,
Dude,
really.
The $300,000 single family home is going the way of the T-Rex.
Yeah.
It really, am I right, Dylan? What do you think? I mean,
Well, I generally agree. I think it's at least a 350 house, if not more. And look, Larry, you've heard me tell this, but I'll say it again. This is because 2 years ago, courageous buyers who didn't stick their head in the sand and go, well, rates are coming down or prices are too high and they're coming down, recognized that, look, I'll buy at 6 before we went to 7. And they bought at 6. They got 5% appreciation the first year on their $300,000 house. They got probably 6 or 7% last year on their now $320,000 house, and it's worth $350,000, and they own it. And they saved $1,000 a month in principal reduction and they didn't rent anymore. It's at least $75, if not $100,000 in budget difference for those people. So at the end of the day, if that's the real math, of course these houses are still flying off the shelves because the math works. You just need to be smart as a buyer to recognize that the math's in your favor and not bury your head in the sand about rates are too high or prices are too high.
You know what?
We talked about
the rates are low. The rates are really low. I mean, when you think about the last whatever 100 years of this, rates are low.
John, although I would give the concession to people that the last time rates were in the 7s, the average house was 180,000 and not 320. But the thing is that you're right in the big picture. But the most important thing I think is, look, rates are rates, and at the end of the day, the thing is that too many people are waiting around for something to get cheaper. Rates,
it's not.
Prices, with no evidence that that's happening. We talked about it in the first segment when we talked about the Fed. Everything's getting more expensive. And so you're going to get, including your damn rent.
Well, hey, check this out. I was just going to get into that. So rents over the last year for a 3-bedroom home in the United States have gone up by what percent? What do you think they've gone up in the last year?
22%.
Oh no, that's too high.
That seems outrageous.
Yeah,
but who knows?
I would just guess that a bunch of stuff came up on renewal and there's less inventory.
Yeah,
I actually thought in a lot of areas, Larry, it's come down a little. The rents.
Yes, it has.
Depends on where you're at. It depends on where you're at.
Absolutely. Right. So in the last year, well, what do you think, John?
5.
Yeah. So you're close, 3.4%. But the point I wanted to make about all this is exactly what you said. It really depends. Like all real estate is local, right? So it really depends on where you're at. Like Austin, Texas,
they're in the toilet.
Typically a very hot real estate market, but their rents have actually gone down.
Yeah.
So, you know, there's a lot of build to rent communities going on out there too. The build to rent space, if you will, has really taken off.
Oh yeah. And they're talking now, like a lot of this stuff being built, these, the new construction stuff, like up in Elgin, and they're building like, $500,000 homes. These are starter homes. Okay.
Yeah.
450 to 5. They're made with the cheapest crap you can find. Go tour one of these homes. I'm telling you, you'll be like, oh my God. I mean, it's the Home Depot $14 light that they're putting into the kitchen. And these things, and they're giving all the incentives. I've got clients I put in a couple of these, and I'm like, geez, these things are, to me, it's crazy that they're, and the taxes are going to be $12,000, in 2 years once it's, kicks in. But the homeowners insurance, it's insane. And the new construction, though, they're buying these rates down for these guys, but that money's, it's coming from somewhere.
Exactly.
It's false money. I had a client lose. We lost the client to a new construction development a couple of weekends ago, and they were all in with us, and they got 6.5 from the builder. And I said, well, what are you getting for that? They're like, well, they're going to buy down the rate, and they're working with the preferred lender, blah, 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 blah. And I was like, what options are they giving you in the house? And there was like $40,000 worth of options. And to get that 6.5 rate, it probably would have cost $10,000. Well, guys, you and I know it probably cost the builder no more than $8,000, probably $5,000, to provide the $40,000 worth of value, air quotes, for those of you listening.
Right.
So it may be hard cost $8,000, hard cost on the discount on the loan $10,000. So that's $18,000. If I could figure out how to slide $18,000 across the table and have you slide $40,000 back, I would do that every day and twice on Sunday.
Yeah, exactly. It's all funny money.
Right. And then the interest rate on these new builds, the interest rate on this new construction, they're starting at 3 or whatever, 4 or 5, whatever it is. But then it's moving up, in a couple of years, they're up at 7 anyways.
Yeah.
And buy down's a whole nother story.
Yeah. Now this buyer's got to absorb the rising cost of the insurance. The taxes are going to go up. I mean, this guy is going to be upside down in 3 years, whoever's buying these,
Dylan, what do you think of this? So of all home purchases out there, 41% of all home purchases are cash. Is that a typical percentage?
It's a very atypical market, Larry. I think that that's a high percentage. Now, the thing is, when you say cash buyers, you think of, um, you know, guy walking in with a suitcase full of money, but that includes all the private equity money that has come into the marketplace. So if you're
Yeah, good
a
point.
hedge fund and you're going to buy 500 houses in a subdivision just outside of
Yeah, good
Boston
point.
or Atlanta, you're gonna raise the money by issuing bonds or whatever. You're gonna walk into your closing for your 500 houses, either all at once or 500 separate times with a wire transfer for cash, and you're not going to take a mortgage. So remember,
Yeah.
that just means without a mortgage when you pay cash.
Yeah, yeah, good
It
point.
doesn't tell
That
you who
all that institutional money is probably
is not mortgage
inflating that.
money.
Yeah.
Yeah,
They might borrow all that money, but they're going to borrow it in the financial markets, and they're going to walk into closing with cash
yes,
Right.
as
very good
opposed to
point.
taking
Hey,
a mortgage.
before we wrap up, John, what do you got in terms of new listings coming on the market? Anything?
I just listed this is what's funny. I mean, Aurora, East Side, 229.9 needs work. I've already had my phone's going off the chart. Listed it this morning. Probably got 10 showings already. It'll be gone.
And this is a typical retail.
A retail deal. It's a former client. He just wants out of it. He's done moving on with life. And then I got a condo in Aurora also coming up. That'll be 120-ish. Everything I got out there listed right now. I've really been getting a lot of listings the last month and a half. It's been pretty good. So,
Awesome.
But I list them. I sell them in 2-3 weeks, and then on to the next one. But yeah, I mean, Aurora minimum's 200 right now. Minimum.
Oh yeah.
That's with tons of work. That's what work needed, and the roofs curling and stuff like that. I mean, it's crazy, man.
I've got one coming on the market in Aurora with an in-ground pool in the back, which is unusual in Aurora, but unless you're in White Eagle or something like that. But
right.
In-ground pool, which is going to come on the market for under $350.
It's not bad.
Yeah, which isn't bad. I got one coming on the market in Chicago on Jefferson Street, which is right in where is that? That's in real hot area. Can't think of it now. I'm having a brain cramp. What's that?
Is that West Loop?
It's not. It's not the West Loop. It's something Market. Help me.
Fulton Market.
Yeah, I think that's Fulton Market.
It's just off West Loop. I mean, it's
in
the West Loop physically.
A great area. Got one coming on there. Another one coming on in Naperville with an in-ground pool. In-ground pools can be great, or they could be the kids.
Or they can be the death knell that a problem.
Who knows? Who knows? Dylan, what's up with you? Anything special going on?
You know what, Larry? We're having a great month here at Neighborhood Loans. So I appreciate you asking. The big thing is, as we talk about this inventory thing, renovation loans, man. We want to. We're working on a couple of those, and it's really, we're buying a place. Now, John's is obviously going to move fairly quickly, but if you're a person who said, hey, you know what, I can't get a decent house, you could buy a less than decent house and get the money to actually fix the kitchens and the bathrooms and some, a curling roof or anything along those lines and build it into your mortgage. I won't go into the details here because it's a long thing, but it's 100% doable, and we close them every day here.
Awesome. Well,
hey, Dylan, is that a 203K?
Mostly. We also have the Fannie Mae renovation product here, and we have.
Which one do you think is a better product, or is it just based on who you are as a buyer?
I think it's much like you just hit it on the head. It depends on the buyer profile. There's no difference in the renovation product because you got to go in and get the project manager consultant and identify the scope of work, and that process is the same no matter which avenue you take, 203K or conforming. So it's really for the borrower, the borrower profile. But at the end of the day, they're both fine products, and the thing is that we've got a company that we're working with on the bidding process and managing the project in terms of hiring a project manager and managing your contractors and their expectations. So that's the thing we do here that's really, really
super
good
important
for the end consumer, because we can. That's how we actually get them to closing and get the project work done in the time allowed. Like it's
It's a
It's
critical
not easy.
point.
It's full contact lending. But you
Yeah.
want look, ultimately the customer wants a finished house, and that's really
Right.
the result we have to get them.
Yeah.
Right.
All right, you guys. It was awesome having you here as always. You guys
Good to see you, boys.
have a great
Dylan,
weekend.
good to see you, man.
Go
Yep,
shoot
likewise, John.
some straight balls and don't lose any. And
You
All
got
right.
it, my friend.
Stay busy, man.
okay,
Stay
I'll
busy.
talk
All
to
right,
you
boys.
guys.
Yep.
Take care, guys.
See ya.
Later.
All right, everybody. So thank you for joining us once again. That was the Real Estate Radio Show and podcast. Remember, you guys can join us on LinkedIn, YouTube, or Facebook every Saturday, 9 a.m. And most Saturdays, you're going to be able to call in as well at 773-763-9278. Today, we couldn't because we are, of course, remote. So you guys have an awesome weekend. And we will be talking to you soon. If I can help you with anything, my name's Larry Shakman. I'm a broker here in Chicago Metro, as well as a title agent. You can reach me at 630-921-0611. I'm happy to help you with anything you're currently working on. Buy, sell, invest. And you guys have an amazing weekend.
Welcome to Real Estate Radio, hosted by Thanks for joining us on Real Estate Radio with your host, Larry Shakman, the real estate therapist and top producing broker. Now, go to TrustedAgentUSA.com and save thousands when you sell, buy, or invest.